In this video, I am going to share with you actionable bear market capital preservation strategies that you can start using today to protect your capital and improve your trading. I'm going to show you the analysis that I have done and tips and tricks that I have found. So stay tuned. This is Mark from TradeInformed.com. There is so much stuff online about how to protect yourself during a bear market, but most of it is waffle. There are no specifics, very little of it is actionable, and the stuff that is actionable is often out of date. I have done some brand new analysis that I'm going to share with you in this video. It is complicated. Getting it right is very difficult, and I'm going to show you what I found. I'm going to help you to replicate my results, and most importantly, I'm going to show you how you can do this yourself. In this video, I am going to cover what are we trying to achieve? What is the point of capital preservation during a bear market? Next, I'm going to look at what makes a good system, something that is implementable and actionable over the long term. What are the specific systems? I have tested loads of different strategies and I boiled it down to 5 different approaches that I'm going to show you. Next, what are your specific requirements? I've got some tips and tricks and some refinements that might be of interest to you. Finally, how can you do this yourself? You need to be doing this yourself. You need to take control of your own financial destiny and do this yourself. Capital preservation is about minimizing drawdowns while maximizing returns. But I didn't say eliminating drawdowns. We are always going to have drawdowns. This is not easy. These two things are often in conflict. What do? The markets are dropping 1 to 2% every day. You're losing money hand over fist every day of inaction. But if you sell today, the markets might rally tomorrow. And there are two sides to this. In 2020, we saw it. People got stranded. They didn't believe the recovery and prices never returned to the lows. You've got to know when to sell, but just as importantly, when to buy back in. So what makes a good system? These are the rules that I have tried to apply to each of these systems. Firstly, it has got to be simple. Otherwise, you will forget the rules because we all do. Secondly, it has got to be easy to execute. Otherwise, you will simply run out of time to do the calculations or you will make mistakes. Finally, most importantly, you have to believe in it. Otherwise, you will not follow it. Now let's get to the good part where we're going to show the actual results. On the screen you can see an Excel-based backtesting system. This is a trade-informed backtest model. You can use it to test all sorts of trading strategies, different markets and different time frames. If you want more information about this, there is a link on the screen at the moment and also below this video. I am going to explain more about this later and how you can use it to empower your trading. So I am looking at the SPY, the Spider ETF with data from 1994 all the way up to 2022, the end of April 2022. And you can see we've got a big span of history here. We're looking at the long-term trends and to see what has worked over the long term. So the first thing that I'm going to look at, strategy system number 1, is Donchian bands. Now these are a deceptively simple way to enter and exit the market based on price channel, high-low price channels. So here I am entering on a 50 bar high and exiting on a 100 bar high, exactly twice as many as my entry. So you can see the results here, and over time it has performed pretty well. You can see the flattening periods here where the system has taken us out of the market. For those of you who have a long-term time horizon, note that there's very few trades, which means you don't have much to do, which is a good thing because you don't want to be chopping and changing in your pension, your retirement account. You want to be minimizing trading costs and maximizing the time that you are in the market. So we can play around with these settings. You can see me doing it here. And you can see the results are changing in real time. See here, once we increase the Donchian band, we are getting a higher return overall, but we are getting hit. In 2020, we had the COVID crash. an exceptional event in many different ways, and you can see that we are getting taken out at that time. But we are capturing a lot of the upside after that. Okay, the next thing I wanted to look at are moving averages. Everyone talks about moving averages, but are they a good way of entering and exiting the market and protecting yourself? So I've looked at three, actually. I've looked at the weighted moving average. I released a video on this recently. If you want to learn more about this very responsive moving average, there's a link on the screen if you want to find more about it. So first of all, let's have a look at the weighted moving average. So what I found with the weighted moving average is that it is more responsive than the EMA and the SMA, but the results are pretty similar. You just need to use a longer period. So I'm going to compare all three of the moving averages. So switching from the SMA to the EMA, and you can see the results are very, very similar. So which of these is better? Well, it doesn't matter. Over the long term, the most important thing is consistency. However, you will notice the values that I'm using in here. I'm using a 400 period, a 400-day weighted moving average, and a 300-day simple and exponential moving average. Now, if I chop this down, which I'm demonstrating here, you can see we are getting a slightly smoother upward curve, but we are missing out on some of the upside. So the advantage of having a very long-term time horizon is that we do want to be in the markets most of the time. When we are on these big bull runs, it has not paid for us to be chopping and changing in and out of the markets. So this is what I have found, is that a higher number of periods has performed better. Okay, so SMA, WMA, EMA, all of them pretty similar. None of them a clear winner, but all of them work pretty well. Okay, what is next? So the SuperTrend. This is an indicator that I really like, the SuperTrend indicator. So I put it on here and I have seen the results that we have got. You can see that I am using here, so I'm going to highlight it here again. I'm using 4 periods, rather a multiplier of 4, which means we have a very wide super trend, which means that we should be trying to capture as much as possible of the uptrend and not chopping and changing. Well, I can increase this, and we can see that over the long term, it's performing pretty well. I like the super trend, but in this case, it's not performing quite as well as the moving averages, and we're getting a lot more trades than the Donchian, the price channel. So super trend, good indicator. As a capital preservation tool, probably not the very best, but I do like it. Now, finally, zigzag. Now, zigzag is an indicator that I have also recorded videos about in the past. Again, there is a link on the screen. Now, there are multiple versions of the zigzag, and it can get confusing. One of these is a repainting technical indicator, which, if you're not sure exactly what that does, it means it can only work on past data and is no use on current data. This is not that version. This is an indicator that moves a set percentage. When the market moves a set percentage from the current point, it will change direction. So it will zig and zag as the market moves up or down. The setting that I'm using is a percentage based setting. I'm set it here. You can see here I've set it to 8%. And this means that if the market falls by 8%, the zigzag will be pointing downwards and will be out of the trade. So you can see, so I can increase that 9%, 10%, etc. And you can see, once again, a slightly higher value means we are capturing more of the long-term return, but we are, in this case, getting more drawdown with that. So there is a trade-off. There is always a trade-off in everything, in backtesting, in life, in general, in trading. There is always a trade-off. So the size of your winners and the size of your drawdown. So I'm going to put it back to 8%, which is a value that I quite like. It keeps us in the market quite a lot of the time. Now there's a way to improve this indicator as well, because the way that I have set it up is to have very few trades. So this would work quite well, again for the retirement account, again for the pension. You don't want to be having a lot of turnover. You can use this to keep yourself in the market most of the time. But for more active traders, I haven't even looked at it yet with the other ones. Let's have a look at the putting in a profit target. And you can see here immediately that we're getting a different type of results. We're getting a lot more trades in general, a lot more winning trades, and we're getting a higher net profit. So this performs pretty well. 4% profit target giving us 80% winning trades over the last 28 years. We can try different values. You can see we're getting somewhat similar values. We're getting a lot of trades, high percentage of winning trades. This is going to suit the more active traders. This is more of a trading strategy that can turn into a capital preservation system. So the trading strategy when things are going well, which is most of the time, let's say 80% of the time we want to be in the market. So we can take regular incremental profits, 4%, 5%, bank the profit, open up a new trade if things are still moving in the right direction. But when they move against us, when we are lower than 8%, then we will not open a new trade until the market rises a further 8% and we are allowed to re-enter. So this solves both the problems that I highlighted at the start of this video, when to exit and when to enter. So I like the zigzag. I think it works well. I think you can see here from the capital graph that it gives us a good balance. It's giving us a good, decent net profit over a long time period. I promise you some specific tips and tricks specific to your particular situation. So firstly, if you have a retirement account, a pension, you want to minimize your turnover. You don't want to be trading regularly. You want to be in the market most of the time. Avoid bear markets, but other than that, be in the market. So you don't want to trade very often. So one way we can do that is to limit our trading just to 1 day a week. And that means all changes just 1 day a week. So looking at the zigzag as an example here, what we can do in this spreadsheet is change which day of the week we trade. So at the moment, you can see here I've got using Excel system 2 means Monday. So only trading on a Monday. If I change this to 3, it means only trading on a Tuesday. And you can see here that there is a lot of variation. Some days certainly appear to be better than other days. However, the key thing is telling me that we don't need to be monitoring our retirement account every day. Once a week is going to give us maybe the same, probably the same on average, maybe in fact even better results than monitoring it every day for your long-term account. So you can change this in this spreadsheet. It's very easy to do that. You could maybe even try once a month or something that is specific to you. So only changing when conditions warrant it, when you're ready to try your system. So the next thing, for people who want to be more active traders, we've got different exit conditions programmed into here. So let's make some changes here. So we can close it after a certain number of bars if the trade is in profit. And you can see what we do here is increase the percentage of winning trades. So many of us, maybe most of us, want to have more winning trades, fewer losing trades. So this is one way to achieve it, to tweak your exit conditions. You're an active trader, but you're not looking at the markets all day long every day. But you can monitor things like this to find the best way to get in and out of your trades. So you can see specific exit conditions. This one here is to close after just 20 bars if the trade is in profit. Another one here, a strength close when the trade is also in profit and we have 3 consecutive days of at least this percentage, then we will close the trade again. So you can see all these tweaks and refinements that you can use to find your particular setup. So there are lots of different things. Oh, there was one further thing as well. What about short trades? You may be wondering, well, this is great for long trades. What about short trades? Well, we can do those as well. So I've programmed in the zigzag to take short trades as well. And I have just checked it so we can have a look at short trades. This is the strategy allowing long and short trades. And you can see that it is a bit more volatile. You see it does really well at certain times. I'm quite certain it does very well during the big bear markets, but it doesn't do as well during the choppy time periods. So this is another option. I said earlier in this video that I was going to explain how you can do this analysis yourself, how you can take control of your financial destiny and your trading. This is the latest Trading Form members model. It is available in the members area for everybody to download and to use and to customize. So if you want more information about that, there is a link on the screen and once again below this video, and you can learn more about that. If you like this video, please hit the like button. Please remember to subscribe to this channel for more content like this about becoming a better trader and investor. And for more information about trading the financial markets, please go to tradinformed.com.